well. So let's use the concepts of price action to form an informed opinion on the IT index today. So let's get straight to it. I have set the IT index on the monthly time frame, and here we can see that it's a no-brainer that after the COVID low on 2020, which is right here, I'll just mark this with a blue line, and it need not be dark because it's really far off and not really doesn't look like it'll be relevant anytime soon. But we will see that the market gave a clear breakout after COVID, and this breakout happened at approximately 16,000-17,000 levels, and the market nearly doubled in a single year or maybe in 2 years. So that's a very strong up move. I mean, we must understand that this is not a stock but the index as a whole. And if the index is giving almost 100% returns in a couple of years, then generally the stocks are doing phenomenally well, at least the bullish stocks. But nonetheless, after it created that high, we can see the formation of a bearish engulfing, which led into a consolidation on the index, and this is happening pretty much around the Ukraine crisis, Russia-Ukraine special operation, so to speak. And we can see this consolidation happened for quite some time, and whenever we see a consolidation, that is, we know that the previous high has not been broken for quite some time, we have to assess if there is a possibility of a pattern. And if we just perhaps look at a curved line this time, and if I can just draw it here and extend this below, we will see that this is looking like a proper saucer pattern. So I'll just darken this. Maybe I'll use a blue here and I'll make it a darker blue. So the intention is to show that there was a base formation and there was a rally, and then subsequently we can see the formation of the handle, right? Again, I'll make this blue. So what we are basically seeing is something like a cup and a handle structure. I'll darken this one. So what we're seeing is a cup and a handle structure, and of course it pretty much broke out at this 36,000 levels, and the low is approximately say 26,000 levels. So obviously we have a target of 10,000 points. I mean, this is 36 where the cup is forming, and the low is approximately 26,000. I'll just shift this image here, it's interfering. So this low is approximately 26,000 and this high is 36,000, and we know that this range then becomes approximately 10,000 points, and 10,000 points from here is 46,000, which is pretty much marked here. And in other words, what the index has just done is, after giving a bullish breakout, it got into a couple handle structure and it has hit the target of that cup and handle structure. So it looks like this move is over. I mean, this particular move, it's so obviously this move is, the cup and handle structure is obviously over, and after that what we are seeing is a reversal back to the range right here. This is fairly obvious, so I'll remove this line. And now once the pattern is over, like I said, that if a security is creating a new high, then obviously we have a bullish bias, and typically what we are looking for are bullish reversal patterns to trade a bullish bias. And we are on the monthly chart, and if we look at it, we are not seeing a pattern, because a pattern, as we can see here in cup and handle, it requires a series of candles to form them. But if we observe a little closely, and I'll bring the cursor here now, and I'll highlight this particular low here, we will see the formation of a hammer candlestick. And now hammer candlestick is a candlestick pattern. So like we have structures like rectangles, diamonds, curves, etc., which form various patterns. For example, if you look at our videos from a couple of days, we discussed the flag pole pattern from Nifty, we discussed the saucer pattern in Nifty Auto, and here we are discussing that the pattern is already closed, the cup and handle. But what has occurred now is the formation of a hammer. A hammer is a single candle pattern, and what it typically signifies is that the low is sort of created. So the hammer low is usually very, very difficult to breach, and so it doesn't mean that the market will reverse to create a new all-time high. So for that, we would want to see some strong patterns, like maybe a W pattern, or some kind of a bullish reversal pattern, which will allow us to bet on the upside of the market. But here what the hammer is allowing is basically allowing us to take a bet on the downside of the market, that the downside of the market is reasonably well defined. Here we are talking about the Nifty IT, because of the formation of this particular hammer. So when a hammer is formed, what we generally expect is that the price action will really slow down, because any upward price action will find some resistance, because we can see this huge red candle. So the midpoint of this red candle in itself is quite a strong resistance, and of course the entire zone is a resistance. So we need a W pattern to form. So we need like a structure that comes till here. I mean, obviously we'll be sort of looking at the closing prices in order to look for the formation of the pattern. And now what we, I mean, I'm just saying the possibilities. There are many possibilities, of course, but one of the possibilities is, like, say it goes here, and then it takes this out eventually. Now this would be a W pattern which would form with respecting the hammer low, and at which point obviously we would know that the targets would be determined by this 40,000 point high, 30,000 point low, and this breakout at 40,000 gives this now a 50,000 target. But this needs to happen, and this is not yet happened. The only thing that has actually so this is all obviously a figment of imagination till it doesn't actually happen. So the only thing that has actually happened is the formation of the hammer. That's the only information we have. And what hammer does is it slows down the downside, and therefore if the security price does come lower, you will find a lot of divergences that will start happening on oscillators on the corresponding time frames. So we cannot see any bullish, like strong bullish technical pattern which allows us to take a bet, except that there is a high of 40,000 and a low of 30,000, and the index is likely to range for some time here, clarifying what to do, and that sometime could be quite some time, because we're looking at the monthly. So this single candle will be around 20 or trade sessions. We'll just move to the weekly to see if we find anything interesting. Obviously these lines now sort of become redundant, and in the weekly what we are seeing is sort of like a formation of a double bottom on this. And some people would argue if this is the neckline of a potential head and shoulder, and the answer is yes. I mean, this does look like a neckline of a potential head and shoulder. So if this is obviously not the neckline, but I mean, you have to imagine the structure like this for someone who's looking at a head and shoulder. Is this the neckline? So in other words, would this low be defended? So now remember, this is where our bias comes in. Since we have a long side bias on the monthly, and a head and shoulder is a bearish reversal pattern, it is impossible that we are going to trade this on the short side. For example, when this security was indeed moving up, we can see the formation of an M pattern right here, but we would not be shorting it. We would simply be booking out our profits, or trailing stop losses would get triggered. So here we will not bet the head and shoulders. We will not bet on the head and shoulders. That is, head and shoulders would obviously mean that if it were to break 30,000, then it gets a target of 15,000, because this is around a 15,000 point difference. We will not bet that this is happening, because our bias is coming from the monthly, which is on the long side. But what we can bet is that this head and shoulders will not break down. Right, you understood? That we will bet that the head and shoulders will not break down. In other words, if the index indeed does come lower, so I'll use this line because this is now irrelevant there. If it indeed comes lower, somewhere around the support, we will take a bet on the long side, and take the bet that the head and shoulder pattern is not going to break, and that the monthly trend of the security is not going to change. And then when we have taken the bet, we shouldn't expect that this will just take off right away. What we should expect is that it will start forming a base and prove that if we are correct or wrong. In other words, we will see that this particular chart structure is more conducive for a value seeker. So if someone were investing into the market for like a really long time, Then the occurrence of the and if they're structurally bullish on the IT index, for whatever reason, I'm bullish on the IT index because the chart is bullish. But would I put my money there? Obviously, before I allocate my money, I would want to analyze all the maybe 10 or 12 odd sectors, rank them, then analyze the individual stocks amongst them, and then rank them, and then decide the top 10, 15, 20 stocks for a particular quarter before I put my money. But what we are actually discussing is that uh, this looks like a chart which will test your patience, and this is a slower chart, and therefore it warrants a lesser position size, lesser quantity. That is, if someone has a very big portfolio, let's say a 10 crore 25 crore portfolio, then IT will form a small component of it because he or she will be value picking. But if someone has a 2 lakh rupee portfolio, then I think there are simply too many better stocks and too many faster moving indexes that we can choose from. So I mean, there is, because the thing is that you cannot allocate like 5% of 2 lakh rupee and consider it a meaningful diversification. That is putting 10,000 rupee on an IT stock. Like, I don't think so. Or say, for example, buying 5 or 7 shares of Infosys or 3 shares of TCS. I don't think so that adds a significant value to the portfolio. What we want when your portfolio is smaller, let's say 2 lakh, 5 lakh, what we are looking for is strong concentrated bets with clear risk management. Because the problem with excessive diversification is that in addition to STT and brokerages, there is a certain minimum cost of holding on to a stock. This is charged by the depositories. So it becomes very unprofitable to hold on to very, very small values. I would think that a minimum bet size of 50,000 to 1 lakh should be there once you have done all the work, analyzed all the sectors, and analyzed all the stocks, and then decided what are your top 10, top 20 stocks, and where are you planning to buying them. So Nifty IT looks like it is weaker than Nifty Auto in the sectors. So since the entire sector is weaker than Nifty Auto, I would look at it, but perhaps much later. So obviously there is a lot of talk happening that the IT sector could boom. There were episodes on news channels that the IT sector could boom. So we are not denying it, but it doesn't look like it. It looks like it is more likely to prove that this 33,000 to 30,000 zone is going to be defended by this sector for a long time. That's what it looks like. Of course, if it changes, we are going to analyze the sectors every few weeks or days, so that the price action of that sector becomes second nature to us, and then when it finally does come to support, we can make a decision. But for now, it doesn't look like there is any strong bullish pattern, and therefore this would be a low priority sector. I hope we have learned a few key takeaways. The key takeaway here was the formation of a hammer on the monthly, the structural uptrend, the assessment of a previous trend, and the potential of value or bottom picking on the stock. So I hope that these key takeaways were useful to you in some way. With that, I would like to wish you all the best for the trading week. And obviously, I would like to wish you and all of your family members a very, very happy Ganesh Chaturthi. Take care.